So you started a company actually 22 years ago. So tell me your journey. You started a company, and then you got bought by Goldman Sachs.
Yeah, I mean, it's one of those slightly surreal, potentially inmates running the asylum kind of scenarios. So got involved in this back in 2020. Was trying to take some time off in 2007 and accidentally co-founded an impact investing company called Imprint Capital. Well, what happened is I had a long-standing promise to my partner. We were going to take some time off, had sold a business. And after 3 weeks roaming around in a bathrobe, moping around the house, I was saved because the Kellogg Foundation, Google.org, and a large family office all said, can we pay you to help us figure out this whole mission investing thing? And I knew some things about it, but I brought out the person who knew a lot more about it than I did, a guy named Taylor Jordan, who at that point, this field was generally seen as, and not entirely unreasonably, as Birkenstock wearers trying to learn Excel, right? Very idealistic people trying to figure out how to take those ideals and apply them to investing. And Taylor was more of a wingtip person than a Birkenstock person, right? And after soberly walking through a process that looked suspiciously like investing with these folks, like you can do this thoughtfully and responsibly, Taylor said, why don't we just do this together? And so Imprint Capital started in 2007 and worked initially with large US foundations, family offices, very impact-oriented folks, but also very sophisticated investors, right? And over time, we noticed our clientele started changing, right? Phones started ringing. It wasn't, the Ford Foundation or the Rockefeller Foundation. It was a large global bank. It was an insurance company. So this was starting to grow 2012, 2013, 2014. And, we thought Goldman Sachs was going to become another client.
Yes, they were clients initially.
Well, no, they weren't. We thought they were going to become a client.
Yeah.
And, maybe I should be disappointed they didn't become a client, but they said, we're very consensus-driven, right? This is going well, but come do one last teach-in, don't mess up, and we'll sign your contract. So went and had a great meeting. They were asking us about greenwashing, and it was funny. I said, well, why? In green bonds. And they said, we just got pitched on a bond that was labeled a green bond for a parking garage, and it was green because it had 2 plugs for electric vehicles. Right, we're like, okay, good.
So this is back in what, 2018?
This was this was 2015.
2015.
This is 2015. And so called back a couple weeks later and said, the meeting went well, it was well received, but we have this wacky idea. What if we were to buy you? And Larry, I was in my I was having my morning coffee. It was one of those drop my coffee mug kind of moments. But and took a while and sort of started to think about why did we start this business in the first place? We started because we wanted to move more money impactfully. We want to do it well, because you're either executing well and you're creating proof points and crowding capital in, or failures, right? And people remember those failures, those cautionary tales for a really long time. And we want to make it accessible to more people. And we realized we were kind of kidding ourselves if we thought our little 15-person company could match what we could do on all 3 of those levers joining Goldman Sachs. And so I spent 4 years in the asset management division, watching as all this got built out and grew. And then, at the top of the house at Goldman, had a long history doing this in different parts of the firm, but sort of something felt like it was happening. So just having a series of conversations, answer 2 questions.
What was happening?
So I think people were seeing.
Actually, I want to do more good, or how did the conversation start?
I think when people started noticing things were happening in the real economy, right? These things which weren't growing so fast were growing a lot faster. Renewable power was really picking up steam. Electric vehicles were starting to really pick up steam. People were talking about circular economy, not out of idealism, but out of practicality, margins, and security of supply. And so these themes were showing up in the real economy. And I think that's really where the conclusion landed. This is not an acronym. It's not a product. It's not marketing. It's a set of thematics that are secular in the real economy around climate transition and inclusive growth. And I think once you have that clarity that these are fundamental themes in the real economy, you need to mobilize yourself around it. We said it's sort of like if you went back 15 years, got out a crystal ball, and looked at technology, right? You wouldn't say it's a company, it's a sector. You'd say this is a factor that's permeating almost every nook and cranny of the economy.
So do you feel finance is getting a bad rep because it's financing all sorts of projects, including fossil fuel?
Well, look, at the end of the day, transitioning the economy in companies is about transitioning the economy in companies. Right, you sort of can't cover your eyes and hope that some parts of the economy just magically change. Right, at the end of the day, this takes work, it takes capital, it takes expertise, it takes advice, and at the end of the day, opting out of that is not particularly helpful. I mean, I was working with a very large, very climate-oriented pension fund client, and I think they came to the conclusion at the end of the day, we can make our portfolio look lower carbon. There will be lower carbon in this portfolio statement, but is that going to get us less carbon in the atmosphere? Right? This paper versus real-world decarbonization. Real-world decarbonization comes from rolling up your sleeves and doing the work, right? It involves capital, it involves advice, it involves all of that, and that's across these sectors.
What would make your life easier? So regulation doesn't speak the same language. We don't have a common terminology. There's not that much data transparency. What do you need?
I'd say a couple different things. I think number one, I spend a lot of time doing what I call clearing the underbrush. Right? There's a lot of jargon, there's a lot of opinions. I like to sometimes say right now we're in the era of ESG hot takes, right? That noise sometimes distracts and it triggers all these mental models and cognitive biases. And at the end of the day, it sometimes if something sounds like a foreign language, a foreign acronym where you need a glossary and a map to be a tourist somewhere else, it's very daunting and it feels removed from their day job, right? At the end of the day, these are material factors that should be in the day job of investors and executives. And the more you make it sound like that's not the case, the more you slow down real progress. And so a lot of it is, it would be great if there were less underbrush created. Oh. But other than that, I mean, I spent a lot of time, I walked through this slide with you earlier, like it's not about E versus S versus G. It's how does this translate economically into risk, growth, and margins, right? That's language that everyone can understand. And, all the different terms and jargon may come in and out of style, but like cash flow never goes out of fashion, right? And I think that's kind of the core idea. And so I guess back to what would make it easier, I think a little less noise. I think hopefully we're going to have an era of kind of more fire, less smoke. I think that would help. I think number two, look, and we've been very outspoken that a price on carbon would help. Right, at the end of the day.
But we won't get it.
Well, and I think, look, what we're seeing, and one thing that's fascinating, I was talking to someone earlier that was saying, well, these are such long-term factors, how do they get woven in to markets and to companies? And what I said, like, what we've discovered is there are more diverse and faster transmission mechanisms that take these things that are supposedly remote and long-term and make them much shorter term and real. So carbon pricing, right? Think about folks like Walmart and Amazon, very large, structurally important players that have very ambitious targets that reach up and down their supply chain, touching almost every nook and cranny. And so the reality is, companies may think, oh, there's not going to be a legislative price on carbon. But if you're in the supply chain of somebody that has that, if you're in the portfolio of an investor that has that, congratulations, there's a de facto price on carbon.
But every big bank, every big financial service, every big investor is afraid of greenwashing, of mislabeling something, of promising something that is just not there. How do you avoid that?
So at the end of the day, I like to say it's about a thesis, not a label, right? If you're solving for a label, I think sometimes that can create those sorts of issues. What do you mean? Is solving for it really getting the right thing? At the end of the day, it's, I think, just going a level deeper. And once again, this is back to, is this a separate side affair? Is this a separate set of products, separate set of tools, or is this integrating this into people's day jobs, right? And I think if it's integrated into the day job, you'll have a core thesis about how this plays out in your portfolio, in companies, whether you're an asset manager, an asset owner, a corporate. And that has real legs, because if that's your conviction about what's going to drive your success as you grow the business and manage it, if you're not solving for appearances, it's going to resonate. And it's interesting, our research colleagues have run through some data which are really interesting. They basically show that companies that actually perform better on these factors, particularly use of human capital, use of physical capital, they have higher returns on capital. Companies that simply disclose more have lower. Right, at the end of the day, back to this kind of more fire, less smoke.
It's the way you do it.
Yeah, exactly. Like if you focus on the things that matter and you execute well, and at the end of the day, that probably sounds a lot like what executives and investors should do. Find the things that matter, get really good at them, and execute.
I know you've charted, investor appetite or the appetite of chief executives to change. What did the last 12 months show you? Because we're dealing with cost of living crisis, we're dealing with inflation and an economic downturn.
Yeah, look, I think the good news in some ways, I think this burns the fluff away, right? This is when all of this gets very real, right? And it reminds people, charts don't all go up and to the right, markets are hard, and macro matters. Right? And I think, we had a few years when people may have lost sight of that. And, there was some panacea thinking that unfolded, right? This is easy, right? Investing is never easy, or at least never for very long. Running a business is never easy and never for very long. And so there's a little bit of a reality check. Now, this is a harsh reality check, and in some cases with really dire human consequences as we think about what's happening globally. But I think in some ways, I think it'll hopefully burn away some of that noise, and people have to focus on, think about what's happening with energy prices in Europe. Being efficient in your operations, that matters a whole lot.
We're also burning coal.
Yeah. No, but I mean, once again, this is what I told someone is, companies, when they think about decarbonization, you know who's happiest are the people that did it 5 years ago, right? The next best time is now, and what this is doing in terms of driving efficiency. The second thing also, supply chain, right? Resilience in supply chain, great relationships up and down that. In times of stress, whether that was COVID, whether that's now, what's happening geopolitically, I think that starts to pay off in a very real world way. It doesn't become an abstract ask of someone else. It becomes an operational organizational imperative. And I think that's what this environment does. It focuses you on what matters. And I think if you can get rid of the labels and the jargon, a lot of this stuff matters, right? And it's not political, it's not ideological, it's not philosophical, it's actually very practical.
So is that how you pitch? You speak to a lot of chief executives or founders. What do they ask you the most? Is there one common question that you get asked at every single meeting?
There are a couple, and they've unfolded a lot. So I think, one is, one of the ones that makes me very happy now is large investors, sovereign wealth funds, pension funds. They say, okay, well, we all know these are real, powerful investment themes, but now it's competitive, right? There's a lot of capital competing in this space, so how do I make money? So it's that next level. I was sort of sitting down with one client, I had to go through, what are the 4 levers of how you actually make money in a backdrop where these themes are actually increasingly well understood, appreciated, and competitive? So, that's a question I love.
And the answer?
Well, so I'll give you the very short version. We can do the longer version in the hallway later. So 4 things I said. Number 1, we have noticed, and this goes back to Imprint Capital in 2007, these thematics go through cycles. And to be simple, but this is how we describe it, too early, too late, and just right. Right? Early on, things are nascent, unproven, often a high failure rate and capital intensive. That's not a great place, particularly for private capital. Eventually, they graduate, they mainstream, they scale, they get access to the bond market. And so, think about utility scale renewables, like very low cost of capital, amply funded. Things have gone through that cycle. So once upon a time, wind and solar went through that. Offshore wind, distributed solar. Now we're looking at battery storage, right? These cycles are very, very similar. And so one way to make money is find things at that Goldilocks spot, right? When you can see something that's graduated from nascency, but the rest of the market either hasn't realized it or hasn't figured out how to access it. Because if you can do that, 2 things are going to happen. 1, you're going to originate assets that people are going to pay you a lot for down the line once they appreciate them. And 2, you're going to create a platform with equity value. That's number 1. Number 2, back to internet days, picks and shovels, right? The $150 trillion that are going to go towards this space, that corporate spend on decarbonization goes into lots of nooks and crannies of the economy. So if you can find those second order effects, a CEO told me, of a pension fund told me, it's a lot easier to pick that there will be a winner than who the winner is. And so picks and shovels, right? No, so picks and shovels lets you do that. People will just benefit from volume regardless of who it goes to. Number 3, make your own luck. Right? A lot of the best deals are made and not found. And so we're seeing a lot of interest in, for example, carving out sustainability businesses from large public companies. So if you do the work, it's like what we did with Northvolt, right? To create a great European battery champion, you need a lot of money. How do you finance something that's not going to have cash flow for a while? Offtake. So we got $15 billion of advanced purchase orders. So that deal was really made and not found. And finally, 4, the green leaders of today are not cheap from a valuation perspective. The green leaders of tomorrow might be.
But where do you find them? So smaller companies or just other regions in the world which we don't necessarily think about?
Or they could be large incumbents in industries that have a lot of work to do, right? I mean, we bought the Danish oil and natural gas company and helped it become Ørsted, right? That was probably a very impactful investment, but also, it's one that financially did well. And so that premium, that gap in terms of valuation, there's a lot of impact to be had and a lot of money to be made there. So those are the 4.
What sector are you most excited about now in terms of transformation or disruption?
All of them. No, honestly, I mean, because we see these are ecosystems, right? And so at the end of the day, as you think about vehicle electrification, well, that's drivetrains, it's batteries, it's actually the actual facilities, it's battery recycling, right? And then, okay, we got to work on charging networks, and then we got to work on distributed power, and that means also solar plus storage. And so each piece, then we got to work on critical mineral sourcing, right? And so each driver cascades to other sort of sub-markets. And I think, as you think about systems, kind of tomorrow's bottleneck is the day after tomorrow's opportunity.
But if you have big companies that either, big polluters that give either big dividends or just have massive returns, how difficult is it to lure investors away from those?
Well,
or is it about the transition?
I mean, I think a lot of those companies see a great chance where when they do have a lot of cash flow and there is transition in their future, they can self-finance it, which I think is actually a great opportunity for they, either on their own or in partnership with other investors.
Optimistic about COP27?
Optimistic. So, look, so far, I think there is a lot of will. I think what's been nice is a lot of people have shown up with transactions that they've executed,
Yep.
not just aspirations. I think that's honestly the thing that I get most excited about, when people show up not saying we commit or we want or we hope, but we did, right? I like a lot of past tense verbs as opposed to just future tense verbs. And so I'm seeing a lot of that, which is good. But I mean, there's a lot of work to be done. And I think that's what's so exciting, being here with everybody and getting the ecosystem in a microcosm together to roll up the sleeves.